Hello my fellow freedom builders and welcome back to another oil video here on the channel. Now yesterday I made a video about if it was about time to put some money into the oil sector, and I gave some arguments that there might be a good case for oil in 2021, and therefore I was completely swamped with questions, with suggestions and so on of small and large oil stocks. So today I thought I would make a quick little video about 5 small oil swing stocks. Well, they're not entirely small, all of them, but at least in the lower end. Some swing potential stocks here that we might be able to find a good little profit in. They are not necessarily fundamentally extremely strong, but maybe if you believe that the oil sector will be moving up and the oil prices will be moving up in the near future, then that would definitely have a tendency to lift the stock price of these 5 candidates as well. First of all, if we look at the chart for oil, I made this video yesterday and we can see after that the oil price kept going up. I am not sure I had any influence on that big a channel. I'm not there yet. But at least the oil kept going up, and you could draw some sort of a trend channel here saying, well, might we hit some sort of area here where we get some resistance? Nobody knows, and if the world economy really starts rolling and the vaccines get out, then that can shoot the oil through the roof here. Also, if the OPEC Plus actually kind of keep the production a bit low, that as well could boost the oil price. That is all about all from the video yesterday. Now then I found 5 stocks and I both put them into my trading view here as well as into Stokopedia. You know Stokopedia from my other videos, but I have it in a link below here as well. Now let's have a look at them. I'll not go deeply into details with them, but the fun part is that several of them are actually not oil producers. They are what is called midstream companies. And when we're talking about the oil sector, as you might remember from my other oil videos, we have an upstream, a midstream and a downstream. And the midstream is basically, of course there are some overlaps, but it is basically the transportation. It could be companies running the pipes, it could be equipment for pipes or for ships or something, where the upstream is the companies that pull the oil up from the ground and the ones delivering equipment for that process. The midstream is the transportation, and the downstream is pretty much the sale of the oil and the marketing of the oil and so on. So that is the 3 main segments here. But we have, I think it is 3 or 4 of the 5 candidates today. They're actually midstream, so that is the transportation. That is maybe a coincidence, I don't know, but it was not something I was specifically looking for. All right. The first one is called, and you can see it in the name, the Magellan Midstream Partners here. And what we can see, let's just have a look at a comparison here where we compare it to the right. Oh, sorry. Let's just have it here. So, as you can see, in my normal method, they are not in what I call the green zone. The RSI is above on a weekly chart, the 50 line, but we can see that on the relative strength chart, it has not moved faster than the S&P 500 for a while here. So what I'm looking for here is actually my shorter term swing trading. And if you have seen the videos about my screening for that, I have a couple of videos about that. But what I'm looking for is I want the price to be above the 200 SMA. I want the price to bounce near the 20 SMA. That is the black line here, as you can see, 20 SMA. And I want that swing here to be with an RSI above 50. So I don't want a swing where the RSI goes below 50. I want it to be above this dotted 50 line here. All right. So here we have it, the Magellan Midstream. We can see that it is bouncing both on the 20 SMA and the 200 SMA. So it is going in at least a beginning uptrend on the daily chart. We can see we have higher bottoms here. We have higher tops. So everything looks pretty well here. Now you could look on the weekly chart and say, does it meet some moving averages? But honestly, you can always find some sort of moving average that will hit the price soon and that will keep you out of the deal. So I'm not looking too much on that. I am looking, however, on some sort of a break of a trend line here. And I am also looking at some higher lows on a weekly chart. And we get this break up here. So I'm quite confident that the weekly chart is also supporting our view. Now, looking at the fundamentals, and I said I would not dive very deep into this. Let's just have these. They are not in the right order. Doesn't matter too much. Here we have it. The quality of the company of the earnings is 75 out of 100. That's fair enough. And the value is 72. The momentum is only 10. And that is, of course, because we have not had a real run in this one yet. So that doesn't really matter too much about the momentum right now. As we can see, it has a PEG ratio of 1.7. So the PE divided by the estimated growth in earnings next year is 1.7. And we want that actually to be below 2 or maybe 2.5. So 1.7 is great. We can see the earnings per share growth estimates are 5.8%. And when we scroll down here, we can see they have some really, really great operating margins. Petrosky scored 5, that is decent. When we look at the earnings per share normalized, we can see that it is kind of steady. It's going up somewhat, and that is great enough. And the free cash flow here, if we can get that, that is kind of not very solid or steady. But it is there and it is positive. And as you can see, that it has a dividend yield of above 9%, which is very great actually. When we just look at it here, it is a fairly great company with a market cap of 8 billion and an enterprise value of 12. There's a big difference there that you could dive into. So it is a fairly sized company actually, and they're paying 9% in dividend. That is kind of amazing actually. What I don't really like is the dividend cover, which is just around 1. And as you can see, they have a free cash flow of here 3, 1.6, 2.8. So they're actually paying out more in dividend than they have in free cash flow. And as you know, I'm not a big fan of that, but there might be in certain sectors and certain industries, there might be a reason for that. Net debt is going up, not the best case, and the working capital is negative. And meaning that when we have a negative working capital and at the same time paying out more in dividend than we have in free cash flow, then this will pretty much, of course, they can get some more cash injected or sell some of their different things in the companies. But this is not the best case. But then again, I'm not looking for owning this company for 10 years. I'm looking for taking advantage of a jump in the oil price and then having some of these smaller companies. I know the Magellan here is fairly large, but I have one of these short-term swings that can really lift up quickly. And companies like this, of course, there's absolutely no guarantee here, but it could fairly easily jump 15, 20, 25%. I have no idea if it will, but when I'm following these strategies and looking at a sector and an industry group that is being lifted by the overall momentum, then this is a fairly good setup. So as we can see, interest coverage not amazing and current and quick ratios are actually way too low. But then again, that is not where I'm really having my focus. We have an analyst consensus around a buy, so that is also fair enough. So that was the first one. You can have a deeper dive into that for yourself. This is not a thorough analysis. It is just some inspiration so you can dive deeper into it for yourself. The next one is enable midstream partners. Again, a midstreamer. And again, you can see this tendency of, let's just have here. You can see there's a big trend line here that is broken. If we zoom in a bit here. A big trend line and broken. A triangle formation is broken to the upside. You can see on the daily chart here that it is above its own 200-day moving average. It is coming up above the 20, bouncing on the 20 with the RSI above 50. It's actually quite a simple setup here. And when we're looking at enable midstream partners here, we can see that quality 53, value 92. Again, not much momentum, but that doesn't matter too much. We have a PEG ratio of 1, that is fair. Price to book value 0.38, that's actually fairly low. Return on capital not amazing, and operating margins are a bit lower than the other ones. Remember, I'm not comparing, even though they're called midstreams, they can actually be making completely different things here. So I'm not comparing apples to apples here, I'm just finding the ones with the good swing setups. We have a Piotrowski score of 6, but a bankruptcy risk that is going into the red with the Altman C score here. That is not fantastic. Let's just have a look at it. We have the fairly stable earnings per share. The low one is trailing 12 months. So it seems like on a year to end fiscal basis, we have a fairly steady level here. Operating margins, we have the free cash flow going slightly upwards here. And again, we see a company here paying an insanely high dividend yield, 22%, 17%, 22%. This is again the trailing 12 month here in the middle. But as you can see, they are actually lowering their dividend yield, it seems like. The dividend per share, but also the yield. And a thing I like about this is that the free cash flow here, it seems like they're trying to adjust the dividend to the free cash flow. So actually here on the trailing 12 month, we have dividends per share at 99 cents and a free cash flow at 1.29. So that is fairly okay. Then, of course, we have some negative earnings per share reported here. So it gets a bit messy here in the dividend cover. That is for certain. But it is a company paying a huge dividend. So, yeah, if you're going for that and if you believe that it is a stable company, as you can see, these companies, and there's some different factors to this because we are in the market cap enterprise value. There are something in the calculations here with the enterprise value that makes with these companies a very big difference. Normally they are quite close to each other, but as you can see, a market cap of $2 billion is a lot smaller than the first one I showed you. But then again, interest coverage, they can almost cover their interest, so it is not a solid company, I would say. But then again, if you're going for the quick swing, it shouldn't concern you too much. This is not a fundamental investor value play. Also, the analyst consensus around a buy here, so that is fair enough. Also one you can have a look at and see if it is something that fits into your investment and risk profile. Then we have Sunoco here. I think it is pronounced Sunoco. And I think you can see kind of the pattern here again. Pretty much the same style as the last ones. We can, depending on where we want to draw our trend lines here, it is quite certain that we have a breakout here. We have the drop down to the 20 SMA. We are way above the 200 SMA. And the RSI is above the 50 line. So on the short-term swing setup, it actually checks out. On this short-term swing trading setup, I'm not demanding it for it to be in the green zone on my weekly chart here. So I just want for instance, a good break of a trend line or a fair setup over here. And then I want the real setup to be on the daily chart. If we have a look at here, we have a Sunoco that is have a high quality, a high value, and again a low momentum. That is kind of the deal with these. As you can see, there's no PEG ratio, and I suppose we can find the reason for that down here. That is because we have negative growth, estimated growth on the earnings per share. So since we are not dividing by a negative number up here, we are simply not showing the number. But earnings per share, it is growing actually over a period of time here. So it is fairly okay, I think. The reason why this is negative is that you can see the trailing 12 month. If we take that away, we can see in 2019 there was a very high number. And the 2020 estimates are actually still fairly decent, higher than in history from 14 to 18. But it is lower than in 2019. There could be some extraordinary incomes there that boosted the earnings per share. We'll have to dive into that. Looking at the free cash flow, 18 was a hard year, it seems, but it has been going up the last couple of years. As you can see, dividends per share is actually lower than their free cash flow. We like that. Dividend yield 11%. It seems like these guys are paying out huge dividends. And we have a net debt that has been going down a bit, and we have a positive working capital. As you can see in 17, they got some capital injection, it seems like. And it is not that the working capital is huge, but then again, 180 million, and we have a market cap around the $2 billion mark. So it's actually not that bad. They can cover their short-term interest. They have current ratio around 1. That is fair enough. Petruski score at 7, but again, down in the higher bankruptcy risk down here. We have the analyst around between a hold and a buy. So again, a candidate that is not completely out of the woods here. It is a bit of a hard time on the economical side, but as a short-term swing trading candidate, I would not have any problem taking this one. All right, 2 more left. We have the Rattler midstream here. And again, you could say, you can see that there's not so much data on this one, but we have this fairly decent defined downtrend on the weekly chart. We have some higher bottoms here. We have a break up. We have a bounce on the 20 SMA and above the RSI 50 line here. So you can see it is basically the same setup I'm looking for every single time. Now, looking at the Rattler here, it's coming up here. We have around a 1 billion in market cap, 2.25 in enterprise value. And when we look at it, we see again a PEG ratio here that is not shown. Let me just see, we don't have an abundance of numbers here. The earnings per share normalized is going up, but the reason why we don't have a PEG ratio is simply because they haven't put in any estimates yet. There can be a number of reasons for that, but as we can see, the trend in the earnings per share is at least quite good here. And that is in 20 and 21, there's absolutely no estimates here. Operating cash flow, free cash flow here, we have negative in 19, but positive in trailing 12 month here. And the dividend cover is, at least in the last trailing 12 month, is lower than the free cash flow. So that is fair enough, but the dividend cover just below 1 here and around 1. And that is because the dividend cover is the dividend compared to the earnings per share and not the free cash flow. That's just me. I want to see that there is enough free cash flow to actually pay the dividend with. Net debt is going up. Working capital is decent. Interest coverage 4.7. That is, I think, the highest of the ones we have looked at so far. So it is not an amazing fundamental company, and it's not extremely large. But then again, for short-term swing trade, as you can see, quality and value is fair. Momentum right now is not really there, but that is what we hope to see with this short-term setup. Last one of the day here is the, I think it is called Sprag Resources. And I think it is the only one with where midstream is not a part of the name. As you can see, it has had a hard time, as long with a lot of other in the oil sector. And here comes a problem with drawing trend lines, because where should we draw the trend lines? I often get questions after my videos saying shouldn't you have drawn the trend line here or there? Or as you can see, I could draw it a number of places, and maybe some of them would be just around where the price is now, and someone would write me and say, isn't that a bit risky buying straight into a trend line? But then again, where should we draw the trend line? There is a million different ways to draw it. And normally I only draw a trend line when I have 3, 4, maybe 5 points, and there are pretty much no other ways to interpret the trend line. Here we can have a number of different trend lines, so therefore I tend to not draw them. But as we can see here, we had the first bounce off the, we actually went a bit below the 20 SMA, but the RSI kept above the 50 line here, so that was fair enough. We can see it has a tendency of forming a bottom here, or at least some sort of range. And you could argue, and I would tend to agree with you, that it is likely that there is some sort of area here that could be nice to see a break of. So you could take the trade here, but you could also have a wait until it breaks up, bounces on this area, and then continues up. But it is not a complete impossible case, and I think there is maybe some room upwards here. When we look at the last of this one, we have, let's just see, the sprag resources. There's so many jump up windows here, can be a bit annoying. Quality a bit lower than the other. Value here, momentum, it has already moved somewhat, so therefore the momentum is a bit higher. We have a PEG ratio of about 0.3 here, so that's actually very low. And it is also so low that I would have a bit of an extra look at it, because it might be because there have been some extraordinary numbers the year before, or extraordinary low numbers and then a very big jump, so we get a huge growth. And as we see here, that is the estimated. They have been dropping in the earnings per share over a couple of years, and then we get a 44, almost 44% expected jump in the growth year. So even though the PE ratio is fair, around 12, then when we divide it with the estimated growth in revenue, or in earnings per share, then we get a very low PEG ratio. So I wouldn't count too much on that. What I will look at is that they have been going down in earnings per share from 14-15, but they seem to have stabilized it here. That is okay. Free cash flow, when negative in 19, shows a bit of a tendency to go up. They are paying 14% in dividend, and they are not having at all free cash flow enough here to pay that dividend. But and we can also see, compared to the earnings per share, we are down at 0.4, 0.5. This is not one I would take for the long run, and especially not as a dividend candidate. I know a lot of dividend investors tend to fall in love with these high dividend yields, but just to remember that when you get a lot above 4, 5, 6% in dividend yield, you should most oftenly look into the case, because there might be something that you need to be aware of. You're not just getting offered 14% in interest without taking any extra risk. There will definitely be some extra risk here when taking on 14-15%. As you can see, it is the smallest one with a market cap of 700 million euro and an enterprise value at 1.2, around that. So dividend cover is really lousy. We have the net debt is stable. We have the working capital is kind of stable. Went negative in 19, yeah, and then supposedly going positive now. Interest coverage is on the low side. Petrushki scored 5, down close to the red zone at the Altman C score. So again, it is not on the brink of bankruptcy, not at all. But again, it is one of these that I would only take as a short-term swing trade if I believe that the oil price would really be boosted now. And we can have a look at this around New Year, or maybe a bit into the new year, and have a look at how it went with these candidates. That can always be a good learning. But as you can see, the analysts are actually, I think this is the lowest one, is moving towards the sell. We can see 3 months ago and then now. So this is something where you could say they are not on a good path if you wanted to keep this company for years and years. But that is not what we are doing. We are looking for swings. And I hope these 5 candidates here, they gave you an idea of what to look for, or at least what I look for. And remember, I'm not a financial advisor, so you should dive into these companies for yourself. I will probably personally not take a single one of these. I don't have any positions in them yet, or I don't have any, not long, not short, and I probably won't take any in it. I have pretty much all of my capital, at least for the US market, tied in some different positions with covered calls, etc. So you can use it for yourself for whatever you like to, and I hope you have been able to take a bit of learning away from this video as well. That's all for now. Remember to subscribe, like the video, hit the bell notification, all that down there. And I hope that you can take care of yourself and your money out there. Bye for now.